Gold isn't heading toward $3,500. $3,500 is the line the market already ran over, and now reserve managers are acting like they can't afford to be late. And the part that should make you sit up isn't the headline drama or the hot takes, it's the quiet behavior underneath it. The kind that only shows up when people responsible for national balance sheets feel pressure building. Because two very different central banks just signaled the same instinct at nearly the same time. Secure the thing with no counterparty, before the crowd figures out why that matters. And if you stay with me to the end, I'm going to give you a simple next 2 weeks checklist. Levels, signals, and the one, if this breaks, the math changes, trigger. So you can watch this like a pro instead of getting yanked around by every candle. Here's the conflict. Gold at these levels makes a lot of narratives look ridiculous. It makes inflation is solved look fragile. It makes the currency system is stable look like a polite fiction. And it makes a certain kind of institution very uncomfortable because their business model is built on confidence and smoothness. So the reflex is always the same. Downplay it, label it emotional, call it a blip, tell you it's already priced in. But markets don't pay you for believing stories. Markets pay you for seeing incentives. And the incentive right now is for anyone exposed to currency stress, geopolitical tail risk, and tightening collateral conditions to quietly reduce dependence on promises. That's not conspiracy. That's portfolio management under stress. And that's where the real pressure starts. Let's talk about the tape first, because this is how people get misled. In early January, spot gold has been trading around the mid 4400s, roughly the $4,180 area, after printing a record peak in late December near 4,150, and then whipping around in a way that punishes both impatient bulls and overconfident shorts. That's not normal, sleepy gold. That's regime behavior. That's a market that's being reweighted in real time, where liquidity thins, gaps show up, and what looks like a pullback turns into a snapback before your brain can update the story. And that whip is the point. Volatility is how the market tests whether demand is real, and it's also how the market shakes out weak positioning. But that's not even the key detail. The next detail is what flips the whole setup. Because when you hear central bank buying, most people imagine a slow, boring bid that's too large and too patient to matter in the short term. That mental model is outdated. Today, the marginal impact isn't the headline tonnage. It's what official buying and official custody choices do to the market's shock absorber. Gold is not just a thing in a vault. A portion of the gold ecosystem functions like collateral, like liquidity, like inventory that can be mobilized through lending, swaps, and leasing. And when the owners of that metal decide to be more restrictive, when they decide they want more control, more domestic storage, less rehypothecation, less sure you can borrow it for a fee, the market can keep trading massive paper volume, but the system becomes less forgiving. The paper can still print. The plumbing just gets tighter. And when the plumbing tightens, price discovery changes. But that's not the part that matters most. The part that matters is who is signaling that they're thinking this way right now. South Korea is a perfect example precisely because it's not a country people associate with gold accumulation headlines. The Bank of Korea hasn't added to its gold since 2013. That's a 12-year pause. And yet the signal coming out of their reserve management commentary has been, we're considering additional gold purchases over the medium to long term, and the timing depends on currency, trajectory, and price. Read that again slowly, because it's a confession. They're telling you their decision matrix is not, do we like gold? It's, do we like the risk profile of a world where our currency can be squeezed and our reserves need shock insurance? That is not a momentum trade. That's a defensive posture, under conditions they consider unstable enough to justify changing a decade-old policy. And when a late mover even opens the door, it tells you something about the room. It tells you the room smells like smoke, and that's where the real pressure starts. Now Brazil. Brazil doesn't have to be a daily gold headline country to matter. In fact, that's why it matters. The most important reserve shifts often happen without fanfare because no central bank wants to shout, we're worried. What you can observe instead is behavior. Official holdings rising, incremental adds in a tight window, and a pattern that lines up with global stress rather than local celebration. Reports and reserve datasets have shown Brazil increasing its gold reserves again into late 2025, with activity clustered across a few months rather than smeared evenly across years. Even if you ignore the exact ton numbers and focus on the shape, the message is clear. A major emerging market reserve manager is choosing more bullion exposure at precisely the moment gold is already expensive. That's not how you behave if you think this is a top. That's how you behave if you think the alternative is worse, and that's the hidden mechanism everyone misses. Official buyers are not trying to beat the market. They're trying to survive scenarios. When survival becomes the objective, price becomes secondary. But that's not the only layer, not even close. To understand why this can move faster than people expect, you have to understand the difference between the gold you see on screens and the gold that actually resolves delivery and collateral stress. Most of the time, the gold market feels infinite because paper volume is enormous. Futures, unallocated accounts, forwards, paper instruments let participants express exposure without demanding immediate physical movement. That's efficient until it isn't. The moment someone insists on specific bars, specific locations, specific timelines, the market is forced to reveal its bottlenecks, refining capacity, transportation logistics, vault throughput, and the simple reality that gold in a vault is not automatically gold available for you tomorrow. This is why you can have a world where gold is liquid in theory and suddenly illiquid in practice. And when that happens, the spread starts telling the truth before spot does. But that's not the part that matters, because the spread isn't just a nerd indicator, it forces behavior. Here's the mechanism in plain language. If physical gold is tight in the place and form people need, borrowing gold becomes more expensive. Lease rates can rise. Forward points can behave strangely. Participants who normally borrow metal to make delivery or smooth settlement suddenly find it harder or more costly. That forces bullion banks and traders to change their posture. They hold more inventory. They pay up for immediate metal. They become less willing to short spot aggressively because their financing is no longer stable. And the moment shorting becomes expensive or risky, the paper market loses a key source of supply. That's how a quiet shift becomes a price move that feels violent. The market isn't being emotional. The market is being constrained. And if you've ever seen a constrained system under stress, you know what happens. It doesn't bend smoothly, it snaps. And that's where the real pressure starts. Now stack your proof like an adult, not like a headline addict. Proof point 1, central bank demand isn't a one-year fad. It has been running at historically high levels for multiple years, with official purchases well above the old pre-2022 norms. When the official sector becomes the persistent marginal buyer, the market's baseline changes. You stop asking, will gold fall back to normal? You start asking, what is normal when the buyer is structural and price insensitive? And that shift is why $3,500 became a speed bump, not a ceiling, but that's not the whole story. Proof point 2, the World Gold Council's own survey work has shown that an overwhelming majority of central banks expect global gold reserves to increase over the next year, and a growing share expect to increase their own reserves over the next 5 years, with a parallel expectation that dollar shares decline. Translate that into market logic. That's not just demand, that's a multi-year allocation drift. That's the kind of drift that turns pullbacks into accumulation windows instead of trend reversals. And if that sounds slow, remember this. In thin liquidity pockets, like early January, slow flows can produce fast price. Proof point 3, supply does not respond on your timeline. Yes, mine punch production can rise, and in fact there have been indications that global mine output has been strong, even on track for record levels in 2025. But that doesn't mean the market is suddenly flooded with free-floating metal. Mining supply is sticky, lead times are long, new projects take years, and a rising price environment often increases hoarding behavior and encourages central banks, refiners, and sovereign entities to lock down metal rather than let it go. Or, recycling can increase, but it also has limits and it responds to local economic conditions. The idea that high prices will bring huge supply is a comforting myth. Gold is abundant geologically. It is not abundant in immediately deliverable form at the exact nodes where the market clears. But that's not even the best part. Proof point 4, the calendar and the margin system. If you watched recent price action across precious metals, you saw a familiar pattern. Volatility spikes, exchange margins get raised, leveraged players are forced to delever, and price briefly pukes, sometimes violently, before the underlying bid reasserts itself. That's not manipulation, that's plumbing. When margins rise, a leveraged long must post more collateral or reduce exposure. Some can't, they sell. That selling can create a dip that looks like a reversal. And then, if the macro and physical bid remain intact, that dip becomes fuel for the next leg higher as forced selling exhausts itself. That's why you'll see it crashed. Headlines right before it rips again. And that is why the next 2 weeks matter. Leverage resets around month turn and early year reallocation windows. And that's where the real pressure starts. Proof point 5. Geopolitics isn't background noise anymore. It's a volatility engine. In early January, a single geopolitical shock was enough to push safe haven demand hard, sending gold back toward its highs. You don't need to trade the politics. You just need to recognize what it does to risk premiums. When geopolitical uncertainty rises, the cost of being underhedged rises. Reserve managers and institutions can't afford to be wrong in tail scenarios. They may tolerate carry costs. They may tolerate opportunity costs. They cannot tolerate existential drawdowns. Gold benefits from that asymmetry. And this is the hidden trick. The better gold performs in crisis moments, the more it becomes a default hedge in the next crisis moment. That's reflexivity. Performance creates adoption. Adoption creates structural demand. Structural demand tightens the market. Tightness makes the next move faster. But that's not the part that matters most. The next detail changes how you should watch the chart. Because you should not watch gold like a normal breakout. You should watch it like a market defending a new regime. Think about what happened into late December, a record high near the $4,550 zone, then a pullback, then a reacceleration. That is classic behavior when a market is trying to decide whether a level is a peak or a platform. In an old regime, new highs often mean exhaustion. In a new regime, new highs often mean repricing. The difference is in the follow-through. Does it collapse and stay weak, or does it hold above key zones and snap back quickly? That's your signal. That's trend versus noise. And right now, the tape is saying the market is unwilling to stay cheap for long. And that matters because if this one level breaks, the math changes. Now, let's address the $3,500 line in the title because it's actually useful. $3,500 was a psychological threshold for the old world, the world where people believed gold should ego cap out because real yields, because the dollar, because opportunity cost. The market ran through it. That doesn't mean it can't fall below it in a brutal liquidation event. It means the narrative ceiling is gone. Once a market demonstrates it can live above a prior impossible level, the next ceiling becomes a question of liquidity and positioning, not ideology. So if you want a clean way to think about this, think in layers. The ideological cap is dead, the structural bid is alive, and the short-term path is determined by liquidity conditions and leverage. That's it. Everything else is noise. But that's not the part that matters. Well, what matters is how those layers interact right now in early January. Early January has a unique energy in markets. Risk budgets reset, portfolios rebalance, new inflows deploy. Thin liquidity is still a thing because many desks are not fully staffed, and the market's tolerance for surprise is low. At the same time, the memory of year-end moves is fresh, and participants are hypersensitive to being caught on the wrong side of a continuation. This is when trend followers get aggressive, this is when shorts get nervous, and this is when price can gap through levels that would normally take weeks to grind through. And when you combine that calendar effect with a market where official sector behavior is supportive, you get a setup where even small catalysts can produce outsized moves. But that's not even the best part. The best part is the hidden detail I promised, the one most people never look at. The hidden detail is that the gold market's liquidity is partly a story told by location and custody. A huge amount of gold is held in major vaulting centers, and a significant portion is owned by official institutions. In normal times, bullion banks can borrow and mobilize metal to meet delivery needs, smooth settlement, and keep the machine humming. But when there's a shock, like a surge in demand to move gold to another region, or policy scare that prompts preemptive repositioning, physical logistics and custody queues can show up. There have been moments where the waiting time to load gold out of key vaults was reported to stretch to weeks, not days. Weeks? That's an eternity in a market that trades every second. And when physical throughput becomes a constraint, you get a subtle but powerful signal. The cost of immediate metal rises relative to future metal. That can show up in forwards, in lease rates, in location premiums, in the way spreads behave. And when that happens, the paper price is not wrong, but it becomes more vulnerable to sudden jumps, because the system's buffer is thinner. That's why official sector decisions matter so much. When central banks are the owners of the buffer, their risk posture becomes everyone's problem. And that's where the real pressure starts. Now you might be thinking, okay, fine, but does this mean gold just goes straight up? No, and anyone telling you it's a straight line is trying to sell you dopamine. Gold can whip around violently, even if the thesis is correct. In fact, the more correct the thesis, the more violent the whips can get, because more people pile in with leverage and then get shaken out. That's why the psychology shield matters. You need a protocol that survives volatility, not a prediction that dies the first time price moves against you. So here's the psychology shield, and it's simple. First, separate thesis from entry. Your thesis can be official demand plus macro uncertainty supports a higher regime, but your entry can be bad, and price can still drop $150 or $250 in a heartbeat. That doesn't invalidate the thesis, it invalidates your timing. Second, recognize the manipulation that doesn't require a manipulator. Margin dynamics. When volatility spikes, margin requirements rise, forced deleveraging happens, and the market creates a dramatic drop that feels like the end. That's not the end. That's the system clearing leverage. Third, decide in advance what would actually change your mind. Not what would scare you, what would change your mind. Because if you don't pick your invalidation rules, the market will pick them for you, and it will pick them at the worst possible moment. And that's where the real pressure starts. Now let's turn this into a near-term roadmap, because this is what you came for. Over the next week or two, you should watch gold through two scenarios. Scenario one is the controlled pullback and retest, and that's the simplest, cleanest technical tell. Second, watch the $4,400 neighborhood because it's psychological and mechanical. Psychological because it's a roundish zone people anchor on. Mechanical because it's near where recent trading is clustered. If gold can stay constructive above that region, dips are more likely to be absorbed. If it slices below and starts living below, the market is telling you leverage is being unwound more aggressively, and you might see a deeper reset. Third, watch the next lower shelf. Call it the $4,300 zone. I'm not handing you a magic number. I'm giving you a behavior zone. If gold loses that area and doesn't reclaim it quickly, you're looking at a larger pullback scenario, possibly toward the $4,100 to $4,000 region, where prior structural buying interest has shown up. That would not automatically invalidate the long-term thesis, but it would change the near-term posture from momentum continuation to rebuild and reaccumulate. And if you're leveraged, that distinction matters, because if this one level breaks, the math changes. Fourth, watch the market structure tells that most people ignore. You don't need to stare at every spread tick, but you should pay attention to whether physical tightness cues are intensifying or relaxing. Are there reports of rising borrowing costs for metal? Are there signs of delivery queues or regional premiums? Are ETF flows returning in a persistent way, adding another source of demand? Is silver acting like a volatility amplifier, suggesting risk appetite is rotating into metals broadly? These aren't random trivia points. They're the plumbing temperature. If the plumbing gets hotter, price can jump. If the plumbing cools, price can drift or pull back without the world ending. Fifth, watch the macro regime drivers with one simple lens. Our real yields and the dollar reinforcing are fighting gold. If gold is rising even while the dollar is firm and yields are sticky, that's a sign the bid is deeper than the usual macro trade. If gold is rising because yields are falling and the dollar is weakening, that's more conventional. Both can be bullish. The difference is what it implies about resilience. The more gold can rally against headwinds, the more you should respect the structural bid. Now let's address the central bank's panicked language without turning this into a courtroom. Central banks don't panic like Twitter panics. They don't tweet. They don't FOMO in public. What they do is adjust risk posture when their models start flashing stress. If South Korea, after a long pause, signals openness to adding gold based on currency trajectory, that's a risk management alarm bell. If Brazil increases gold holdings into a period of elevated global uncertainty, that's a hedge decision. If the broader survey data shows central banks collectively expect more gold and less dollar share over the next 5 years, that's a structural shift. Put those together and panic becomes a fair emotional translation of a very cold institutional reality. They want less exposure to promises, more exposure to settlement final assets, and once that preference becomes widespread, it doesn't reverse easily. But that's not the part that matters. The part that matters is what it forces other players to do. When central banks and sovereign entities treat gold as core collateral, it changes the behavior of everyone else. It encourages other reserve managers to follow, because nobody wants to be the last one holding the asset everyone is quietly reducing. It encourages institutions to reevaluate their hedging frameworks because gold's role becomes more central in crisis correlation. It encourages retail and private wealth to treat dips differently because the who is buying question becomes harder to dismiss. And it pressures the paper market because a persistent price-insensitive bid makes it more dangerous to short rallies aggressively. That's not drama, that's microstructure. And that's where the real pressure starts. Now, let us talk about the one thing that can trip up even strong theses. Narrative warfare through volatility. You are going to see days where gold drops hard and the headlines will say gold tumbles as fears ease or profit-taking wipes out gains. That's not analysis. That's a caption generator. The market can drop because someone needed liquidity elsewhere, because a margin hike forced selling, because an options dealer needed to hedge, because a large macro fund rebalanced, because a single flow hit a thin book. None of that tells you the thesis changed. It tells you the market is doing what markets do, clearing positions. Your job is to treat volatility as information about positioning, not as a moral judgment on your beliefs. So here's the practical, sane approach. If you're a long-term holder, your focus is not the day-to-day noise. Your focus is whether the structural regime remains intact, central bank demand remains supportive, macro uncertainty remains elevated, and the plumbing doesn't suddenly loosen in a way that makes physical scarcity irrelevant. If you're tactical, your focus is on levels and behavior. Do we hold key zones? Do we reclaim quickly after dips? Do breakouts hold on retests? And do the moves happen on thin liquidity events that suggest urgency? And if you're leveraged, your focus should be survival first. Because leverage is how correct views get destroyed. Volatility doesn't have to beat your thesis, it just has to beat your margin. And that's where the real pressure starts. Let AS bring it back to the core claim. Why could gold explode on further from here? And what would make $3,500 feel laughably small in hindsight? The answer is not one factor. It's the stack. It's official sector allocation drift away from dollar concentration. It's geopolitics creating recurring demand for crisis hedges. It's market plumbing tightening when custody and mobility become constraints. It's leveraged positioning and margin dynamics creating violent resets that ultimately reinforce the trend. It is a supply response that cannot flood the market quickly at the exact nodes where the market clears. And it's the psychology of a world that has lost faith in smooth outcomes. That's the stack. Remove one layer and the move can slow. Keep the layers and the move can accelerate. But that's not the part that matters. The part that matters is that you don't have to predict the exact top or bottom to benefit from understanding the mechanism. You just need to recognize when you're in a market where the rules changed. And the simplest evidence the rules changed is this. Gold delivered an annual performance in 2025 that belongs in a history book. And it did it while central banks remained buyers and the world remained unstable. That's not a normal cycle. That's a repricing of trust. And repricing of trust doesn't end because 1 week got quiet. So here's your checklist for the next week or two, the one you can actually use. Watch the $4,550 zone for a break and hold versus a reject and reset. Watch the $4,400 area for whether dips are absorbed quickly or whether price starts living below it. Watch the $4,300 shelf as your near-term math changes zone. Lose it cleanly, and we're probably in a deeper pullback regime toward lower supports where the market can rebuild. Watch for any renewed signs that physical tightness is increasing, higher borrowing costs, settlement delays, location premiums, because those are the pressure gauges. Watch macro drivers with the real yield and dollar lens, but don't be fooled if gold rallies against headwinds. That's often the stronger signal. And most importantly, watch your own behavior. If you feel the urge to chase after a vertical candle, that's your brain trying to buy certainty at the highest price. If you feel the urge to panic sell after a sharp flush, that's your brain trying to buy relief at the lowest price. The market makes money by selling you those feelings. Don't buy them. And if you want a final grounded way to think about the upside without making stupid promises, anchor it to regime acceptance rather than fantasies.